All right, it is day two, possibly, right, as Dave mentioned, of this sort of stimulus fuel gains that we could see out of China here today. It really has lifted many boats overnight as well. You take a look at how the global stocks and the exposure to China, we'll talk about that in just a bit here. But yes, first early and out, right? I think we're 40 minutes early with that PBOC MLF cut this morning, that 1 year cut by 30 basis points. It was much expected, though, just given the announcement, the massive stimulus boost that we saw yesterday here as well. So no surprise, but probably another kind of shot in the arm for this equity market here today. You take a look at how Asia stocks are doing. We're continuing on and riding on that party here today. The Nikkei is flat, though, but Taipei coming online pretty strong. We're up some 1%. We also had some weaker data coming out of the U.S. when it comes to consumer confidence. That did shift some of the swaps to more favor a 50 basis point cut in November. I think it's a bit of a toss-up now on what goes on there as well. U.S. futures are slightly in the negative. We're watching the dollar story very closely when it comes to the Aussie dollar. That continues to go strength to strength after the RBA. But the Thai baht, the Malaysian ringgit, certainly hitting those milestones here. The Thai baht rising to the strongest since March of 2022. The ringgit's, I think, surging about 1% here this morning. So the Fed story plus the China strength story, given what we're seeing in the renminbi, breaking below that 7 handle for the first time since May of 2023. That's really catching a bit for commodities. Look at copper prices. We're back to those 2-month highs for LME. Also, iron ore in Singapore continuing. We saw, I think, a surge of 5 or 6% yesterday. We're up some 3.5% again. Iron ore and Dalian also surging this morning. You take a look at how everything from your ETFs to Nasdaq Golden Dragon, and it was investor euphoria when it comes to what they heard from Pan Gongsheng and co yesterday. You take a look at what we saw the Nasdaq Golden Dragon. It was up some 9%. K-Web was up 10% as well. And even those stocks in Europe as well as in the U.S., and even that had any sort of China exposure, whether it's luxury, the like, really like the news of what we got. Everything from rate cuts, triple R cuts, mortgage rate cuts, and also about even talk about this stock stabilization fund is helping this equity market here this morning. You take a look at how the approach to the open is. Futures have been punching higher and sizably higher here today. When watching, of course, the renminbi, that's the big one to watch. Hang Seng, I mean, we were talking about 3-4% gains on Hang Seng, 8 shares, all that yesterday, and we saw one of the best days for the Hang Seng since 2024. CSI 300 had one of the best days since 2020 as well. It's rare, Dave, to see futures punching 2% or more this morning. Yeah, so we're likely going to get a gap higher again at the open in 26 minutes from now, and certainly market breadth, momentum, technicals are all pointing to a further bounce. Now, the other question, of course, is how much short covering was, the move yesterday, and certainly you look at some of the data coming out. I think JPMorgan put out a note just a couple of minutes back, and they did see this drop in, short selling as a percentage of the turnover, so that dropped to 1 standard deviation. In any case, of course, whatever gives this price move up even further. So a couple of sectors to watch here: consumer property, so consumer staples and discretionary. Property for obvious reasons, brokers on the back of some of the programs set to alleviate and boost the equity market. And just I would say about 30 minutes back, this news that Hong Kong might be looking to reduce the taxes on liquor or hard liquor might boost the likes of Maltai, of course, which those product categories tend to qualify as far as that is concerned. 1 year MLF, we're done with that as well. Metals rally just about across the board, and we have already taken out the 7 level on CNH. Do we get CNY, which is about 0.5% from that specific level? Yeah, let's bring in our senior equities reporter, Abhishek Vishnu here. Abhishek, I know it was a busy day for you and your team yesterday. I'm guessing today could be just as busy. What do you make of the price action? Is the rebound tactical, or is it something more structural, as fiscal stimulus is still missing in this whole picture?
Yeah, it's a bit more than tactical, but falls short of being structural right now. But, having said that, what China did was rare, big, bold, very public and very coordinated. We have been here around these levels earlier as well, and some form of stimulus measures have come in. But yesterday's moves have trumped all of that. Now, if like you guys have been reporting, you've been talking on television at how everything that is a derivative of China demand or China story, right from MXAP to MSCI emerging markets, copper, everything is rallying. So imagine if the derivative is rallying, the main instrument, which is China story, should rally even further, and that's what golden dragons bounce overnight reflected. Now, if you look at the stimulus, obviously a lot more of monetary side has been addressed. So this helps the valuations. This helps the liquidity in the system. Again, a liquidity-driven, valuation-driven sort of rally. But there is marginal impact on consumption too. Whatever money that gets left in the hands of consumers can add possibly 0.2 percentage points in GDP as per some economists, some market strategists. But this is still small. So if China sort of takes it forward with fiscal side of things like bond issuance, higher deficit, higher fiscal spending, then the narrative goes from just addressing the PE to addressing the EPS growth as well, and then it becomes structural. Remember, market is voting right now. It's a voting machine saying that this is good for the market in the short term. But there would come a point in time where it starts weighing how good exactly it is. So slightly more than tactical, the narrative has gone from being an empty jar to at least glass half full for China equities.
And is it too early to then ask the question, will this have broader implications on reversing an almost seemingly structural trend of the receding presence of Chinese equities in global benchmarks, MSCI EM for one? Does this change that broader narrative, do you think?
Well, there is time for that, but I was talking to a lot of strategists yesterday, and there's budding enthusiasm, at least on the sell side, that some sort of rotation, it should happen, is likely to happen, at least from asset classes which are which have rallied way more, benefited from China's downtrend. Say something like gold, say something like Japan equities, maybe even India equities or US Max 7. So some sort of budding enthusiasm is there, but that's limited to sell side right now. We are not seeing that coming in from investors. Having said that, look at the setup. Fed is cutting rates, right? So you are expecting value to do great. Where is value? MSCI China is trading at 9 times. That is where value is. So, the role of China as a diversifier, as a value play, that gets a leg up from these measures. So, the hope is this enthusiasm would continue, and hopefully government would see merit in doing a similar sort of move on fiscal side, and you'll get that EPS narrative, the all-important narrative back, and we will see a structural upswing in both China's economy and therefore China's market.
Abhishek, fantastic there. Abhishek Vishnoi, they're a senior reporter for Asian equity markets. To Abhishek's point, we are set to get a day 2. Futures are flying again ahead of the open today. Our next guest says China's monetary policy announcement is the boldest economic supporting package since at least 2020. That's when COVID hit. Becky Liu, a very busy person yesterday, still to be very busy today, has made time to step into our studios today, head of China macro strategy at Standard Chartered Bank. We've had about 24 hours now to take a step back and assess what was announced. What's your initial take on the content?
Well, it's a package including not only monetary policy, but also very solid support to both the real estate market as well as equities, together with credit lending. So it's a whole package that will likely to at least see some downside of economic growth in the short term. And probably more importantly, it signals a change of the policy stance. It went from a highly reluctant stance to stimulate the economy or showing such a high degree of tolerance for slower growth over the last 2 years towards one that's much more proactive. So that's why from a pure monetary policies point of view, this is not only about the outsized 20 basis point of cut, but it's about the expectation that more cuts are coming in a faster and more frequent pace. So we are looking for at least a quarterly cut of the open market operation rate in the foreseeable future.
Was it enough, though, to fight off some of the deflationary pressures we're seeing in this economy, though?
No. So it's not enough to change the whole economic dynamic yet. It raised market sentiment, it raised a risk sentiment towards China assets, but deflationary pressure is something very structural in our view. There are two main reasons. One is the real estate sector. Its deceleration has actually been gathering momentum so far this year. So it's not really moderating from the last 2 years. Things are actually deteriorating at a faster pace. And second, it's because of a very supply side focused policy. So there are still a lot of focus on manufacturing sector building up the capex, and domestic demand or anything stimulating the consumption side remains absent. For example, one of the biggest pillar that's missing from yesterday's conference, in our view, is fiscal policy. Yeah. So there's no one presenting from the Ministry of Finance, and there's no discussion about fiscal policy at this stage.
Well, it would have been disappointing if they were there and didn't say anything. So I guess we'll have to wait until their press briefing takes place. A lot of people were wondering why China wasn't doing more or doing what they did yesterday earlier on. And I'm wondering, the Fed cut rates by 50 last week, and did that open an opportunity or window for the PBOC to come out with a big bazooka yesterday? Yeah. And might it be the best case scenario for China that the Fed continues cutting interest rates so they can continue doing what they're doing?
Exactly. So if you look at what PBOC have been doing, they have preemptively cut 10 bits in July, and they cut 20 bits yesterday. So for a 50 bits of Fed rates cut, then the PBOC actually matched that by 30 basis points. That's pretty aggressive by historical standard. And that means they will be able to do more cuts in the coming month. And we do expect another at least 10 bits cut in the fourth quarter of this year. So that would be a much better scenario for China to finally able to design its own monetary policy that's based on its own fundamental, economic fundamental and inflation fundamental. So that's a material deviation from the situation in the last 2 years. Due to concern about FX stability, they were unable to cut when deflationary pressure actually points to the need to ease more.
So where does that leave rates next year or even to year end? Does it open the door for more OMO cuts, deposit rate cuts? How are you forecasting that now?
We believe deposit rate cut will also come pretty aggressively, because currently, with the Fed being likely the fastest, the central bank that will be cutting the fastest across all the major central banks, at least up to the first half of next year, then external environment is no longer a constraint for the PBOC. But domestic constraints, i.e. the banking sector NIM, become the biggest focus at this stage. So we do expect them to be cutting deposit rates fairly quickly, especially for the corporates, and we do not rule out the possibility for deposit rates falling towards zero in the next 2 to 3 years.
Any expectations right now from what the finance ministry should be doing next then?
We believe we need to see a step up of fiscal impulse, because so far this year, although they have been arguing that they wanted to have a proactive fiscal policy, but if you look at fiscal spending, it's down by 2.9% versus a year ago, and also down from the previous year. So it's a de facto tightening of fiscal policy, and that has been the biggest drag to the economy since the second quarter of this year. And the biggest reason comes from a decline of fiscal income by 6%. So that is the biggest decline in over a decade. And if we assume the same pace of decline of fiscal income for the remainder of this year, what's already planned when it comes to fiscal resources would only allow a 8% increase of fiscal expenditure versus the same period of last year. And that is not enough in our view. So we do believe that they need to either raise the official budget deficit to allow the central governments to issue more bonds, or to simply allow greater flexibility for the usage of local governments' project bonds.
How high does that government budget deficit have to be now?
This year, the de facto budget deficit, under a broad concept, based on our calculation, is about 8.1% of GDP. So it's a small widening from last year. But the biggest problem is that income has been dropping faster than expected, both in terms of tax income or in terms of land sales income.
Okay, we'll have more from Becky Leung a bit later on the show, head of China macro strategy at Standard Chartered Bank. We should be getting the renminbi fix of the day just out right now. You see it on your screen.
702.02,
there we go.
Which is in line with estimates, but certainly you have to wonder what the PBOC is thinking, right? Are we going to see some more pushback, just given the strength that we see now that we broke below that 7 handle here? I think we saw between the gap between onshore and offshore, it's about 200 pips overnight as well. So certainly one to watch here, 702.02 against the dollar.
Yep.
And our big take today looks at just how China's stimulus package came together just after weeks of growing anxiety among senior leaders. But economists our team spoke to say President Xi's adrenaline shot is only buying China a little time. Subscribers, you can read this story on the terminal and Bloomberg.com. We're counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. Futures are punching much higher here this morning. We're likely to see another good day across these markets. This is the China Show. All right, we just had that renminbi fix, and certainly watching very closely where these levels of dollar China are going to go. Still with us is Becky Liu, head of China macro strategy at Stanchart. You mentioned about breaking below that 7 handle for dollar China is significant. How much momentum is behind this sort of strength now?
In the near term, very near term, ahead of the U.S. election, we think there's further downside. And one of the biggest reasons is the corporate positioning is just too heavy. We know that China's export has been pretty strong, and therefore trade balance this year is a new record high, up by 11% from the same period of last year. But all the way up to July, most of the Chinese exporters has been accumulating dollar. It's only started from August that they stop accumulating dollar. But at this stage, we feel that the bulk of them have not yet unwinded the previous heavy position. So now they are still holding a record position of FX on their book. But if we look at dollar CNY today, it's already at a tipping point that if they are still not squaring the FX position, the risk is for the move to hurt their P&L. So previously, the higher dollar deposit rate and also very high dollar CNY was very good, positively contributing to a actually FX gain from not hedging and not converting back to the CNY. But now, if they're still not moving, and if dollar CNY is having another leg down, they will start to incur losses from the FX operations.
Yeah, let's just have a brief look at the CGB curve right now. 2, 5, 10. And your 30-year yield. So we were briefly at about 2% yesterday. We then took out back above, as you can see right now. And the question is, with this massive stimulus that's about to hit the market, might that mean lower yields, or is this actually reflationary? And could that mean actually counterintuitively higher yields? Becky, what do you think? Where do you think yields are going to go here?
We think yields still have more room to come lower from here. So yesterday we did see, for example, CGB futures was selling off because of the very strong equity momentum. Okay. But ultimately we are at a beginning of a more aggressive monetary policy and rate cut cycle here. And therefore, from CGB yields perspective, currently we're still keeping our 10-year CGB forecast at 2%. But we also believe that the risk for that to fall below 2% is actually getting higher.
Does that mean that policymakers will be taking a step back from that intervention then in the bond market?
We feel the upcoming intervention will likely to be much more modest than what happened over the previous few months. So after all, they're now more convinced that monetary policy needs to ease more and ease more aggressively. And all those so-called operational twists by selling back-end bonds and buying more front-end bonds is actually counterproductive. And if we look back into yesterday's announcement, a number of policies will actually lead to an expansion of the PBOC's balance sheet. So ultimately, they are not only cutting rates, but also trying to inject more base money through an expansion of monetary, through central bank balance sheet. And therefore, we believe that any upcoming intervention on the back end of the curve will likely to be much more limited. And therefore, we are looking for a further bold flattening of the curve in the slightly medium to long term before the end of this year.
You know, that's a good point that, I think not a lot of people notice. The PBOC was central to all the, the funding activities, right? You had the swap program with the brokers. And, I mean, should we call it QE? Like, what is this the notion that this might be a step towards some level of quantitative easing, of, an expansion of the balance sheet? Is that something that we should be talking about, or am I just overthinking it?
At this stage, the first target is to stop QT, because previously, all the lending facilities interest rates were too high compared with market rates. And therefore, we noticed that they have been cutting MLF rates at a faster pace than the open market operation rate, because it's like between 20 to 40 basis points higher than the market funding cost, and therefore banks has been repaying money. So the PBOC's balance sheet ending up was shrinking, and therefore the proposed policies at this stage, in our view, will likely to at least stabilize the trend and lead to some expansion of the balance sheet. But a massive QE at its current form, it's probably not the base case yet.
Becky, thank you so much for spending, 15 minutes of your time. Very busy. We'll let you get back to work. And hi to your team, by the way. Fantastic there. Head of China Macro Strategy at Standard Chartered Bank. Going into the open. Oh, wow. The Hang Seng, 3% to the upside. We're now at 19.5 on the benchmark. Dollar China's at 7, below 7. And 10 cents is now trading at the highest level since 2022. The opening bell, 7 minutes away. You're watching The China Show. All right, the sun might be lingering behind the clouds, but I can guarantee you the bulls are out in force again in these Chinese markets in Hong Kong and over in Shanghai. We're called higher 3%. So do we get a day two? The short answer early Wednesday is absolutely yes. We're looking at substantial gains still. Now, the other question, of course, is how much of this is still short covering. We did see, of course, a paring back in short positions yesterday. No doubt, though, the common denominator so far has been what was announced was very different, was very special, and something for mostly everybody based on some of the commentary we've gotten so far.
Yeah, some of the big banks really commenting after and talking more about, it seems like policymakers are more receptive going to Morgan Stanley to this alternative policy options. Goldman Sachs signals a new round of policy easing ahead here as well. And Nomura, though, Ting Lu still not too convinced, right? He says, you can't have monetary and fiscal policies alone are insufficient to arrest this worsening slowdown. In terms of stocks to watch here today, we're watching very close to the property sector. That certainly was one of the key beneficiaries yesterday here, and we are seeing another field day for some of these developers here this morning. The banks also reacting possibly to the stimulus, also that MLF cut that just came through just a few minutes ago. The Open is next. This is Bloomberg. Are better days ahead? That's the big question when it comes to what Chinese equities are going to do after what we saw was this a massive sort of stimulus package that was unveiled yesterday, just an hour, or I should say a day ago this time, and really how we were glued to that press briefing here, and really has had a bit of a, I guess you could say, buzz to what really is leading to these markets to rebound in a big way. Is this something that is sustainable is still the key question. It looks like we're seeing day two of this, Dave.
At least in price, yes. Yeah. And not to rain on the parade, but certainly we did see a resetting of positions, similar to what we saw during the reopening from COVID, of course, and the abandoning of COVID zero. Simply the reason I bring that up is things like the drop in short covering, this massive spike in turnover. 20 billion shares were traded yesterday on the CSI 300. So things like volumes and turnover, plus some of the technicals, the 4 or 5% pop yesterday just got us back above not just 3,400, but the 50-day moving average on the benchmark itself. And as you can see, some strong gains again out of the gates across some of the heavy weights here. Iron ore is called 6% higher still. So it's not just an equity market story. We did see that across global mining stocks. A lot of the metals, as you can see, are still seeing gains of about 1, 2, 3, 4%. Now, again, is this simply a resetting of positions? Were things oversold to some extent? I mean, the answer is yes. So we'll see what happens here moving forward. And certainly what you want to pay attention to is dispersion within sectors and dispersion between onshore and offshore. And certainly you could make the argument the announcements yesterday were more targeted to the onshore market, things like the swap program for example, between the PBOC and the brokers. Let's flip the boards, please. And by the way, since we're looking at some of the Maotais and Wu Liangyes of the world, we also have a separate story you can read all about on the Bloomberg. This scoop that Hong Kong might be looking to take down some of the taxes on hard liquor. Okay, that's not a call to do something or come up with bad decisions, let's put it that way, but it might help the economy. Tencent at 416, 417 is now trading at the highest level since 2022. We closed above 400, and this gap higher sends us back to levels we saw last about 2 years ago. 3% to the upside, 19.5 on the Hang Seng Index. Now, we still have ways to go. We'll talk about this later in terms of how far are we from year-to-date highs. It depends on which benchmark you're looking at here, but we're about on the Hang Seng China Index, for example, I think it's about 3 to 5% still, going back to the very top. Hang Seng China Index is now on the longest winning streak, going back to 2018. Right, let's have a look at a sense of breadth, for example. So yesterday, you have nearly 5,100 stocks between the Shanghai Comp and the Shenzhen Comp. Nearly 5,000 of those stocks, about 96, 97% of stocks were traded to the upside. Maybe smaller sample size is the CSI 300, and out of the gates is still a similar picture. 295 stocks, 3 down, 2 unchanged. Let's have a look at what we're doing as far as Hong Kong is concerned. And I think the benchmark we're using here is the Hang Seng Index. 500 points, 80 stocks up, 2 down. Tencent, as you can see in terms of points, is leading this up about 3%. But as you can see, every single stock on the Hong Kong benchmark is high, with the exception of 2 which are either unchanged or down. So let's wait for this to really get warmed up, Yvonne.
Yeah, it looks like it already is in some ways. Particularly when it comes to some of these inflation numbers coming through from Australia here, this could be a good one here for the RBA. So we're basically seeing the inflation number at 2.7%. That was in line with estimates. But yeah, quite a slowing of price pressures here from the previous month of 3.5%. What that means is that we've actually seen CPI prices back into that target band for the RBA's target band of 2 to 3% for the first time since April of 2021. Keep in mind, though, this is a day after we heard from Michelle Bullock, who was quite hawkish still when it comes to her forward guidance and saying, they basically could still go in either direction here for the RBA. So you're seeing the Aussie dollar actually drop and pare back some of the initial gains here this morning on the back of that CPI print as well.
Yeah, well, it's certainly one part of the global equity market where at least inflation is still, to some extent, lingering.
They're still doing things differently there.
Yeah. They're still, I think they're open to either way still, right? They're still not committing either way. But I think our guys at BE think that there is a path to a possible easing before the end of the year.
Yeah.
I guess
I think pricing is still for the first cut in February, though, next year.
Yeah, okay. So, patience is a virtue, as they say.
We'll see.
We've been very patient, though, watching this Chinese market. We're about nearly 3-4 years into the bear market onshore, and might events this week have changed the direction of travel here. It's early days, but certainly on price, we're up 5 to 10%, depending on which benchmark, over 2 days. Lilian Leung is with us here on set, portfolio manager for the China Income Fund at JPMorgan Asset Management. Before we talk about, and good morning, by the way, sorry, before we talk about what policy means for your strategies, what do you think about what they announced yesterday? Impressed?
Well, I think definitely is a positive surprise in the sense about it's a more targeted and well-coordinated set of monetary easing policy. I think that's probably the key positive surprise to the market, and definitely has recovered some of investor sentiment. How effective it is, it probably will take some time to see. But then versus some of the stimulus kind of policy that they have announced so far, it's been a more better coordinated one. Yeah.
Is this more short covering we're seeing across these markets now, or do you think it's time to think about some sort of re-rating of Chinese stocks?
Well, I think short covering, in particular for offshore market, yes, and potential recovering of the valuation that will also follow through, because I think valuation in China, as you just mentioned, I mean, China market has been under this kind of long bear market for such a long time, and valuation have been very attractive. So we need to see some restoration of investor confidence, and also when now we are seeing improvement in liquidity. So valuation here, liquidity is improving. The next, how sustainable that kind of rebound would be, I think it depends on the when are we going to see the EPS rebound to come. It probably will be a bit later, but then when it comes, then the recovery or the rebound will be a lot more sustainable.
Yeah, I mean, it will probably take at least a couple of weeks before we figure out really how markets really feel about this.
Yeah.
Yesterday, though, we saw a rush back to the underperformers, consumer staples and the like, and I'm wondering what that does for the winners that have emerged so far this year, like the banks, for example. How do you think this affects, because banks make up, I believe, a good portion of your strategy, for example?
Yes, we do overweight banks a little bit, but incrementally we are seeing more attractive valuation, risk reward, and kind of just the reward kind of opportunities from like other financials like insurance. They're all trading at still pretty depressed kind of valuation, and of course because of some of the kind of concern about all this kind of property exposure, potential kind of, the back end, weak consumer sentiment about the demand of insurance policy, and all this kind of negative, backdrop hitting the kind of valuation. But then when we start to see some unwinding of this kind of concern, the valuation should be back to a little bit more kind of normalized kind of level. So I think even for banks, although they have outperformed in particular in the Asia market, if you look at within the Hong Kong exchange market, the valuation is still very attractive because in particular over the last few weeks, people have been concerned about the NIM pressure from lower interest rate. And the policy, PBOC's stance, the statement yesterday suggests that the NIM pressure should be quite well contained. So therefore, we also see a quite decent rebound in some of the big banks, big SOE banks as well.
What did you make of this? They're considering some sort of stabilization fund, some target measures towards the stock market in particular, right? This direct lending from the PBOC for brokerages to buy stocks, or even facilitate more buybacks from companies. Do you see brokerages and companies really following through on that?
Yeah, I think that's a bit of question mark because for brokers, brokers, the prop desk kind of the book is not really that big. So whether they've got sufficient incentive to do so is still a question mark too. We probably need some time to see. And for buyback, I think lots of companies have been committed to buyback already, in particular for those cash-rich companies. So I think there should be kind of incremental kind of sentiment improvement, but whether how big this particular package would be in terms of driving the market probably would not be that substantial.
Implications for some of the consumer staples and discretionary stocks, which a lot of people were waiting for a catalyst. Did they get that? And how do you view that very depressed part of the equity market onshore?
Yeah, I think the key question about all this kind of consumer is about when are we going to see some stabilization of the deflationary pressure? Because these have been dragged down by all the deflation of kind of deflationary pressure dragging down on the top line, and they have been doing lots of cost control, but then it's still lots of pressure on the margins. So when when we start to see some stabilization of the deflation, then that will be definitely a kind of good catalyst for these kind of stocks. Sectors to rebound, in particular for the leaders, because we have been seeing, their kind of very strong capability to control the cost, to improve the cost efficiency. So their margin have not been really hit that badly. It's just that the top line has been under pressure that basically dragged the kind of valuation. So I think by the time when we start to see some stabilization of deflation, then that will be the time.
It's going to take a long time, though.
Well, yeah, that's probably take longer than the kind of monetary easing probably will not be enough. That's why.
Our question today is, whether this breakout means much for the rest of the year. Do you think stocks can ride on the stimulus wave until year end? And do you think Chinese stocks can actually be the outperformer by the end of this year?
Well, I think one very favorable backdrop is about the kind of U.S. interest rate cut cycle started. So I think that usually tends to be more, friendly to all emerging market, and valuation for Chinese stocks have been very, very attractive. So we are basically seeing two favorable kind of backdrop to support the kind of rebound. So I think we have got a good chance. We remain pretty constructive of the kind of medium-term outlook of the Chinese equities, and we just need to see some potential EPS revision, positive revision, and that rely more on the inflation kind of figures.
Lilian, great to have you. Lilian Leung there, portfolio manager at the China Income Fund at JPMorgan Asset Management. Still ahead, bottoms up. Hong Kong set to cut its tax on spirits in a bid to revive its once legendary nightlife scene. We're going to discuss the chances of a liquor-led recovery next. This is Bloomberg.
Welcome back. You're watching the China Show. 12 minutes into the session, it took us 2 days for the CSI 300 to reverse all the losses for the year. Up now about 3%. So as things stand, we're effectively back to square one year to date on the mainland benchmark. MSCI China is up 5%. Okay, yeah, I'm getting too excited here. 3%. Give us a break. It's been a while since we've seen markets rally, not just once, but twice in these heavy volumes. But again, we've been here before. So we'll see it last.
There's been a few false dawns, right? Yeah. So I think, when it comes to the sell side, maybe they're a little bit more optimistic than maybe the buy side.
They tend to be
rightfully
quicker,
so.
though.
Yeah. But we'll see how this all plays out, right? But day two, there you go. It took a few days. I think it took a while for investors to really kind of cling on to this idea of this massive stimulus that we got here. But we got a lot of news coming out from Hong Kong as well.
Yeah, it's certainly reason to cheer, as they say, or cheers. So we've learned from sources that the government is planning to lower taxes on spirits as it seeks to regain its edge, Hong Kong at least, as a nightlife and dining destination.
Yeah, meanwhile, residential property rents are nearing a record high. That's thanks to an influx of expats and students from the mainland. Let's bring in our team, Shirley Zhao and Crystal Chia, on both those stories. Shirley, I'll start with you with that scoop. So, obviously we've seen Lan Kwai Fong, not the same. How big of a deal is this, lowering the tax for spirits?
So it's expected that this can promote trade. For example, the government in 2008 removed the wine tax, and after that, in the following year, the kind of revenue generated by the wine industry has ballooned, and also, there are more businesses related to wine setting up in Hong Kong, including restaurants, bars, and hotels, and of course, people's consumption of wine suddenly jumped. So it's expected that this removal or lowering of the spirits tax is going to achieve a similar effect on trade and on people's spending. It's expected that bars can now introduce more varieties of liquor, which will enable them to, for example, create more different types of cocktails and offer more sorts of spirits to customers. Basically, there will be more options available. Whether people will indeed spend more, it remains to be seen.
So how much is the tax now? So what's the current rule? And if they do remove or lower the tax, will just that encourage people to binge drink on just hard liquor, which is not bad for the pocket, but also bad for your liver?
Right. So the current level is 100% of the value of the liquor containing more than 30% of alcohol, which is among the world's highest. Even in mainland China, it's much lower than that. And, in other places like, Singapore, it's a different rule. They measure it by volume instead of by, the amount of alcohol. Right. So, and we learned from sources that one of the approaches that the government is considering is a tiered system. So more expensive liquor will be charged less tax. That's to encourage people to spend more on premium liquor, but at the same time, not making cheaper spirits even cheaper. So that's a way to discourage people to binge drink on, really cheap booze.
Yeah, hopefully it still fills the streets a little bit more than we've seen of late. Crystal, rents are rising, though. I think it's, 6 straight months that we've seen. Are there districts that you see that are rising more than others?
Yeah, so rents are now just 1.2% below their previous historical high. And it's quite interesting, there are districts that are rising more than others. For example, the districts that are near to universities or actually near to the high-speed rail with Shenzhen. So this actually reflects the demographic that's coming in, which is a lot of mainland Chinese, whether they are mainland nationals coming under the top talent pass scheme or they are students. These districts that they have preferred, such as Zhongguang or Olympic, those districts have risen a lot more than the other traditional expat or luxury districts such as Repulse Bay.
What's the longer-term outlook? Can this continue? Can rents continue to just go through the roof?
So some experts think that this surge in rents, it's only short-lived because there are a lot of structural downsides. Hong Kong's population is shrinking, and also the income growth is near to stagnation. So that means that if a household's income cannot keep up with the increase in rents, they would have to allocate a bigger proportion of their income to renting.
Okay, team, thank you so much. Shirley Zhao and Crystal Chia there on really all things Hong Kong. Hopefully we get a boost to the property market and also F&B. And by the way, before we talk about the newsletter, just a plug here as well. So tomorrow is the Bloomberg Buy-Side Forum, and we'll be speaking with, on Hong Kong, Christopher Hui. So we'll see what he thinks and where we go with the financial sector and what their plans are to further boost the economy here.
Yep, and of course you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter that's out every Thursday. You can sign up via Bloomberg.com/newsletters. I'm sure you're going to see Shirley and Crystal stories out there this week. Play more ahead. This is Bloomberg. All right, welcome back. We've got another scoop for you on the push OpenAI has made to the White House. Now, sources tell us the startup wants the U.S. to build massive data centers. Let's get more now from our tech reporter, Annabelle Jewelers. This would be a pretty unprecedented build-up, I should say.
Blowout on the data center front with
blowout
an
of power demand, for sure.
Look, there's a lot of energy demand. That's what we're hearing. So we know that Sam Altman's been meeting with White House officials and talking about this need for data centers. They need more data centers to make sure that the US basically stays competitive, stays ahead of China in particular when it comes to advanced AI. And so that's what we're hearing from sources, essentially, is that they've shared a document with government officials and outlining the benefits of such data centers. So, yeah, hearing that it could be 5 gigawatt data centers. The size of it is not really specified just yet. We did hear from some people that actually looked at 5 times 5 gigawatt data centers, but it's really massive energy needs.
Is it possible? Is it feasible? Like, what needs to happen for that to happen?
Well, it sort of depends on the size of the data center. So, again, it wasn't specified in the document. If you're looking at the energy needs, I mean, 5 gigawatts is roughly the size of 5 nuclear reactors. You're talking about powering maybe 3 million homes. So it's large. If you have, there are sites in the US that can accommodate 1 gigawatt data center. 5 gigawatts, we're hearing from sources, maybe that's not as feasible, as in if you have one data center that powers 5 gigawatts, maybe not so feasible, but there are sites that can have that. Yeah, big question mark over this, but it is very ambitious, really trying to push out that energy infrastructure in the US. But this has kind of become one of the major talking points in AI now, just the sheer amount of energy demand that's needed, where you're really overpowering national energy grids, essentially, and that really brings to the fore the need to sort of push ahead with some more advanced cooling technology to try and reduce those power needs.
And OpenAI also, meanwhile, is rolling out a new feature on ChatGPT.
Yeah, so they've brought out this new voice assistant, essentially. It's available to all paid ChatGPT users. This is something that was actually announced earlier this year, but they delayed that to sort of work through some potential safety issues. So OpenAI is saying that the product isn't going to be able to impersonate how other people speak, for instance. That had been one of the concerns. They've also added some new features to make sure that it can sort of spot and refuse some requests. So if you're asking it to generate music, for instance, or other forms of copyrighted audio, so they've tried to sort of stop that from happening. So, yes, just sort of the next iteration, essentially, but they are saying that they're going to have even more features rather to come in the future.
Bill, thank you so much. Annabelle Jewelers there on this OpenAI story. Briefly back to markets here. So we're on day 2. We are on day 2, definitive, 23 minutes into the session here. And we're looking at cash markets, bid substantially. Equity markets on your left, and this is not just a China story, although most of the gains we're seeing is in China. We're getting really a bit across EMFX, particularly when you look at what's happening in the currency markets, right, which have someone taken a back seat because of the eye-popping moves we're seeing in stocks. But this is probably driven by also what the Fed did and this bid we're seeing across Asian FX.
Yeah, you're basically seeing those two tailwinds, right? Where you have dollar CNY that's around 7 or breaking below that, plus the fact that there are more participants in this market that are leaning towards a 50 basis point cut, another one in November as well. That's really saying the dollar lower, and that's why you're seeing that bid across EMFX here in this part of the world. But yeah, what is substantially moving higher is what you see, the CSI 300. You don't normally see moves of that nature, same for commodities, right? Whether it's rubber, zinc, as well as steel, all rallying quite a bit here this morning. That's why you're seeing some of these miners do very, very well, right? Just given we saw copper rebounded to that 2-week high, yet iron ore prices continue to surge. The metals certainly were benefiting and liking the idea of more stimulus crossing through, whether it is that cut to the mortgage rate that might help at least the property sector. But you're hearing the likes of Citi this morning say it's unlikely still to turn around this housing slump.
I mean, it's a good time to take stock, certainly, and try and think about what yesterday's announcement does not look to achieve beyond the price. But I'll lean on the silver lining here. The Bloomberg China Property Index is up over 20% from the bottom. So you could call that somewhat a bull market, although if you take a step back, maybe it's not. But it's certainly a good start as we move into day two. Keep an eye on miners on your screens. Keep an eye on luxury stocks. The second hour of the China show is just ahead.
Welcome back to the China Show. A look at the CSI 300 a half hour into the session, and wow, it is a good second day when it comes to equities here. Onshore, you're seeing up some 3% here right now, so we're extending that rally that was really, $500 billion worth just Tuesday on the back of this stimulus blitz that we saw from the PBOC yesterday as well. So that leads us to basically, all those year-to-date losses that we talked about. Oh, yeah, they're gone now, Dave.
Yeah, it took 2-3 days to get us back to 3,400. We're also back above the 50-day moving average. I think 20 billion shares were traded yesterday, so we're also looking at sort of second derivatives here, like volume, turnover. I think as far as Hong Kong is concerned, and that note coming out of Wendy Liu out of JPMorgan, pay attention to short positioning as well. I think we did see that ratio to turnover shrink to about 1 standard deviation beyond your mean. Flip the boards, please. So year to date, we're looking like this. We're looking slightly up now. As far as the other benchmarks go, 2.8% on the CSI 300. MSCI China's at 5.3%. And you know what? I think there's one color. And I don't need to get into that as well. Right. Let's have a look at the broader story, which is a related story as well. So we pay attention to the Chinese currency. So on dollar China offshore, we were, past tense, about an hour or so back, below 7. We're still above that right now. We're slightly behind on dollar onshore, but as you can see, it's also playing out across EMFX here. So dollar ringgit, the Thai baht, I believe, was a redhead, which also crossed the Bloomberg terminal about 90 minutes back. And you know what? We also have to thank the Fed for what we're seeing today. And might they have opened that window of opportunity for the PBOC to jump through, and they did jump through that yesterday. Asia ex-China looking like this. So we're doing very well after closing at the high since 2022 in the regional benchmark. And yeah, so we're continuing to track the story on day two.
Yeah, was it a bazooka? Did it meet expectations? I mean, we had a lot of guests comment on this in the last 24 hours or so. Let's take a listen.
Chinese markets have gone through a long period of underperformance, almost to a stage where people just don't want to be there. And I think what these moves are saying is that probably we've reached the end of that underperformance.
I think the things that we would need to see to fundamentally alter the trajectory are the ingredients to this would include reforms that ultimately push the savings rate down and drive structurally higher demand from the household sector.
I think they need to take more decisive measures and significantly larger scale funding to help stabilize the property market.
It signals a change of the policy stance. It went from a highly reluctant stance to stimulate the economy or showing such a high degree of tolerance for slower growth over the last 2 years towards one that's much more proactive.
How effective it is, it probably would take some time to see. But then versus some of the stimulus kind of policy that they have announced so far, it's been a more better coordinated one.
And not to mention that China also cut its 1-year lending rates 30 basis points about an hour or so back. So let's put everything together with our team. Bloomberg Intelligence joins us right now, our Chief Asia FX and Rate Strategist, Stephen Chu, and also to talk us to the equity angle, Marvin Chen, of course, who oversees equity strategy for us as well. Marvin, I'll start with you. Your initial views here on this stimulus blitz.
Yeah, we really think that China policymakers went above and beyond expectations this time. Sure, some of the interest rate cuts, triple R cuts were expected, and actually yesterday markets were kind of giving back gains in early trading before the real surprise, which was the PBOC facilities for stock purchases. So a couple of things stood out to us. One is that policymakers are finally realizing that drip Fed stimulus was not working and that they needed to come out with a big jolt. Second is that the national team support that we've been tracking all year is now officially sponsored by the PBOC. So, the central bank is telling financial institutions, corporates to borrow from us, leverage up to invest in the stock market. So the market does not need to question if, the national team is in play anymore. So overall, I think these measures are some of the broadest and most direct that we've seen. Yeah.
Big question, is it going to last? I mean, some say this could be just a technical bounce. What separates that from being something more structural?
Yeah, I think we're going to be on a sugar high for a while, particularly given that the Fed and PBOC are finally on the same easing cycle. Valuations are going to move first. And for China, single-digit valuations have quite a bit of room to go before kind of reaching that 5-year average of 11 to 12 times. For sustainability, it will come down to the data showing improvement on we need to see improvement on consumption, housing sector activity, and deflationary pressures ease. And if we get that, we think that the setup it would be a pretty good setup for stocks going into 2025.
Right. There are the elections, of course, and geopolitics, which we can get to in a moment. But Stephen, I'll bring you in. In the meantime, the sugar high, the sugar rush has taken dollar China below 7. Is there a lot of momentum behind that move? Can that continue?
Yeah, I mean, we have to distinguish whether the latest bazooka, as you said, will really help the economy. We'll leave that to the economists, but at least for China, it's always sentiment. Chinese stocks, Chinese currency, it's always sentiment that drives the near-term movement. So as you can see, the offshore yuan actually tests 7. Now it has rebounded, but now at least it has broke through the 7, the highest level since last year, basically. And onshore yuan, it's a matter of time that it's going to break 7 again. As Marvin said, the Fed has really helped as well. PBOC also delivered a lot of stimulus. So the currency, actually, the direction will be intact. Of course, how fast the yuan will rally will depend on how the PBOC will let it. Now, if you look at the basket, interestingly, it's actually not that strong. It's still at 98.5, which is somewhat stable this year, meaning that there could be a lot of room for the dollar yuan to drop from here.
But you're saying there's still some cracks that we have to look ahead to. What does it look like post U.S. election when you have to talk about trade wars once again?
I think beyond all this stimulus hype and also beyond the U.S. election, obviously the top risk is the U.S.-China relationship, because we don't know who is going to win. If Trump comes on, obviously there could be a U.S. trade war 2.0. But even if it's Kamala Harris, we know U.S.-China relationship is just going to go south because of obvious reasons. So that could be a risk premium that's yet to be priced in the yuan. And of course, at some point, people will look at whether the Fed will cut all the way below 3% next year. If not, then the Fed rate cut path will have to be repriced. That will support the dollar. So from the dollar front, that will actually sort of slow the yuan rally as well.
We're counting down to the U.S. elections, as Stephen was pointing out. Marvin, geopolitics, when does that kick back in and remind these equity markets that there is something to talk about there?
Yeah, I think, with the stimulus, the big announcement yesterday, the question becomes, has all this easing been front-loaded ahead of the U.S. elections? And if we do get more tariffs, does the Chinese policymakers have more firepower? And, we think that, it remains to be seen, but the external risks are definitely there. But we think that, with this recent strengthening in the yuan, and if the Fed continues to ease as expected, there is room for more policy easing going forward. And I think that sentiment was kind of reflected in the announcement yesterday when some of these measures were hinted that, they can be extended if necessary.
What does it mean? We saw a lot of momentum in the equity market kind of take some wind away from the bond rally, right, where CGB actually rose on the back of this announcement. Has all this been priced into the bond market? And should we find a floor for yields now?
I think CGB yields, especially the 10 years, sort of rebound from record lows yesterday, which is quite counterintuitive because it's like a massive stimulus, rate cuts, triple R cuts, and even forward guidance for more triple R cut before year end. So you would have expected yields to drop lower. But now that tells you that China, after all, is an EM market, so better sentiment will actually sort of help yields. So the growth story, at least for now, is baked in. So people expect recovery in the property sector, in the real economy, and hence 10-year yields, which reflects the macro sentiment, actually sort of rebound from here.
Very quickly, final thoughts, Marvin. How do I position in the equity markets right now?
Yeah, so similar to the Fed easing that has broadened out the U.S. market from the Mag 7, we think China easing will kind of broaden out sector performance. So this means we're looking at some of the laggards, consumer staples, healthcare, and real estate. And also it means that we think that, A shares can narrow some of the underperformance to offshore listed stocks going forward.
Marvin, thank you, Marvin Chen there. Also our thanks to Stephen Chu, our BI Chief Asia FX strategist there, and Marvin, our equity expert, of course. The big take today is all about what we just heard yesterday as well, and really kind of taking a step back on what this all means, right? Is the ball now in President Xi's court? Just given what we heard from the PBOC, economists in our team are saying that President Xi is now really the adrenaline shot is the only, at this time, buying time, right? We need to see more follow through when it comes to fiscal policies to really let this sort of reflation story take wind in some ways, Dave.
Yeah, when we get that, watch this market stretch its legs even further. Right, just ahead here as well, we're pivoting to India and having a look at the outlook for private markets there with, Carlyle, the country head for the firm there. Plus, of course, we're pivoting back to China and talking about tourism with Club Med, and we'll see what they're seeing as far as bookings and the outlook ahead, not just of Golden Week, but of course ahead of the fourth quarter. Plenty more ahead in store, suffice to say. You're watching The China Show. Good morning. Okay, markets continue to position and discount for perhaps more easing ahead, and certainly the equity market angle and the programs directed at the equity market is showing up in the Asia market. Our Marvin Chen just pointing out a few minutes back how to position for this. Look at the laggards and look at the onshore market. Look to close the gap with the offshore market, with the CSI 300 up 3%. We're now back above water for 2024.
I like what he said, right? That we heard from the central bank in some way sponsoring this sort of national team buying.
We no longer have to speculate.
We don't have to speculate whether the national team stepped in or not anymore, because you have the PBOC giving direct lending to brokers and really facilitating more stock buybacks for a lot of companies out there. That, in terms of sentiment, is huge, according to Marvin Chen. This is what we're seeing here today. In terms of movers, of course, we're watching very closely what happens when it comes to luxury sort of names here. We saw what happened in the European session with some of those big names like Mercedes, for example, BMW, Volkswagen, Porsche, and this is what we're seeing here in Asia, right? So some of those luxury shares that you're taking, like Prada here in Hong Kong, Samsonite, that's just what they're doing here this morning as well. Looks like we're seeing a bit more of that follow through, but keep in mind some of these are listed in the European session, like LVMH, Hermes as well. Certainly, we're focusing on the luxury sector very closely here. The CEO of Swiss watchmaker Breitling says he's confident the luxury sector has reached a bottom. George Kern spoke to us about the company's outlook as a slowdown in China takes its toll on high-end brands around the world.
China has been tough over the last couple of months. Now they have announced yesterday a couple of impulses in terms of interest rates, so I hope this will improve the situation. The problem of the Swiss watch industry of many brands is that some of them are dependent on the Chinese market. Some brands are selling 50% to China, 50% of their overall sales to China, including or excluding even tourist sales to Chinese outside of China. Thank God this is not the case for Breitling. Our sales in China represent 6%. You need to have a plane with 4 or 5 engines. If one engine doesn't work, just hope that the other 4 engines are working, and this is the case for us.
You're just coming from Hong Kong as well. How's the situation there? I mean, we have seen so much pessimism about the city.
It is also more difficult. Hong Kong and Macau. Hong Kong used to be even bigger than China 20 years ago, a huge market, and it has been decreasing. But in the region, I've also visited India, I've visited Malaysia, Indonesia, and all these countries are doing very well. Malaysia is also doing very well. So, as I said, you shouldn't be dependent as a brand from one country only and put all the eggs in the same basket. Europe has been stabilizing. Switzerland is doing very well. USA, which is our biggest market, has been growing strong single digit over the last couple of months. So yeah, let's hope it will continue.
Are you concerned about potential slowdown in the U.S. economy? Consumer confidence just dropping a lot.
Yes, but everybody is talking about a recession in the U.S. since years, and it never happened. So I think the U.S. economy is probably the most resilient economy in the world, and I believe independently on any political changes you might have there, that the economy will be doing good.
Diversifying away from China, India, you talked about India earlier. How big is that market for you, and what's the potential? Because there's so much excitement.
Yes, it's one of these. I mean, it's 1.6 billion people. It's bigger than the Chinese market. It has been growing.
But for luxury.
Yeah, it's growing tremendously. Indians used to buy in Dubai or in England. Now you have trade agreements with India, so the market is much more open. The malls, there are many more malls opening, so there's more distribution also for the luxury industry. It will be the 3rd biggest economy in the world in the next 5 years, so it's gigantic. Obviously, you have a huge difference between the very rich people and the very poor people. I think they need to develop the middle class, but the market is there, the wealth is there. So therefore, I see that many luxury companies are putting lots of efforts into that market, including ourselves. We're opening 2 or 3 more boutiques in India, in all the cities, and it's looking good. And thank God we have this country also.
Yeah, there we go. That was Breitling CEO George Kern speaking with our colleague, of course, Sherry on over in Tokyo. Just a quick glance at the cryptocurrency space with Bitcoin effectively trading. These are about 1-month highs here. I guess to one end, really this embracing of risk following the Fed in China. And we'll see, of course, whether we can extend these gains across the crypto space.
Yeah, and focusing on China and the crypto world, it seems like the mainland's over-the-counter cryptocurrency brokers are said to be seeing a record streak of demand. Estimates from Chainalysis reveal that inflows topped $20 billion in each of the 3 quarters through June, reflecting hunger when it comes to alternative investments. Let's bring in our cryptocurrency reporter, Savastri Ghosh. Savastri, so why is this happening in China now?
Hi, Yvonne. That's really a very interesting question, and the main theme goes back to the slowdown in China. So we are seeing that investors are now looking for, quick returns, easy returns, fast returns, and given that the slowdown in the stocks, in the property markets, investors are looking for other alternative channels. And as we know that Bitcoin has risen by 140%, and as you were just mentioning that, it's still going up today. So that is the main reason, the lure for higher returns is the main reason that we are seeing this trend of OTC trades in China picking up in the last 3 quarters.
Isn't this illegal, though? I mean, what does this mean for the ban in crypto, I think is the broader question there.
Yeah, exactly. It's a broader question. It's an important question, especially, David, as you rightly said, that there is a ban in crypto in China. And that actually, and just to put this number of $75.4 billion of OTC crypto trades that we have seen in the last 3 quarters from Chainalysis, that number itself shows that it's a huge number. Why? Because in Hong Kong, where the crypto trading is legal, we saw about $87 billion of crypto trades in the 12 months from July last year, whereas OTC trading in China is just a small part of the overall trading, and that itself is showing more than $75 billion. That shows that the ban in China is not yet foolproof. And it also shows a lot of pent-up demand when you talk about crypto and the OG country of the largest cryptocurrency market at one point of time. We still see a lot of demand from investors in China there, despite the ban in crypto.
Yeah. Didn't imagine we'd hear OG on the shows today, but there we go. Thank you so much, Shrivashri Ghoshti, our cryptocurrency reporter, on a fascinating story here. Right, speaking of China, the rally continues, day two. Plenty more ahead. This is Bloomberg.
Well, welcome back to the China Show. IMF Managing Director Kristalina Georgieva told Bloomberg that the U.S. is in a good place when it comes to inflation, but warns that slow growth and high debt is something to worry about.
Two very important points for your audience. Number one, yes, growth is holding, but by historic standards, it is not high enough to retain good prospects for our economies. Before the pandemic, average growth 3.8%. Two, we also have very high debt levels. And that combination of slow growth and high debt is something that we at the fund worry about. What we want to see is countries taking seriously the importance of fiscal prudence. So the central banks have done their job. They fought inflation. Inflation is going down. Rates are going down. We need the fiscal side to be equally committed. And of course, we want to see more attention as to what drives growth up.
I want to go back to inflation, though. With the Fed finally making that big move last week, that half-a-point cut, inflation defeated, mission accomplished, done? Or would you say not necessarily yet?
Well, watch it. Yes, we are in a very good place. We have been predicting soft landing. We would see inflation down and growth still remaining firmly in positive territory. This is where we are.
Right.
We know that in the services, inflation is still flaring a little bit more, so the Fed is going to watch it. But broadly, we think that the Fed got it right, and we would see how that evolves in the next meeting of the Fed. Not to exclude there could be more cuts. But again, why is the Fed successful? Because it is data-driven. So they would watch incoming data very carefully.
There we go. The IMF Managing Director, Kristalina Georgieva, speaking with our colleagues there. Of course, on your screen was Callum Massar there, talking about inflation, maybe really why we're in this situation now where rates are coming down and equity markets are melting up. An update here on the CSI 300, day two. Volumes, I just had a look at my screens, 150% above your 30-day average. And as you can see, we've sliced through your three moving averages over the matter of just 2 days or so. I guess to borrow a phrase, I think it was 2001, Moulin Rouge, come what may, suddenly the world seems like a perfect place, and how things have turned over the course of just a few days here in this market.
Yeah, and as you know, we've been talking to our strategists about, it's look at the laggards, right? And look at the property sector and what these property stocks are doing. They're flying, and for another day. Citi has an interesting take on it this morning. You know, they said, look, what we're seeing, what we saw in these stimulus measures to support the property market will likely have a limited impact on sales, but they do still expect some more initiatives that could be introduced in the coming weeks. So that's something to look out for here. But you know, what the impact could be more on is more on volumes, more so than price, just given what the inventory situation is looking like here today. But there you go. You see the likes of Sunac China still surging some 10% here as well. And liquor stocks, right? Is there something to really celebrate now when it comes to not just these markets, these stimulus measures, but really Hong Kong, according to our sources and Shirley Zhao's reporting, plans to cut taxes on spirits as well, try to revive the nightlife there. And yeah, you are seeing some of these stocks like Moutai, for example, is up some 3%. Global macro movers are looking like this here today. And yeah, it's a sea of green, really. If you take a look at how risk assets are looking at, it's the China stimulus story, it's the Fed as well, as we continue to see more Fed officials talk about more cuts to come. You had data that continues to slow down the U.S. as well. Dollar is basically on offer here against most Asia FX, and it is seemingly like the renminbi is leading that charge after we briefly touched below 7 against the dollar.
Yep, there's a lot of momentum here, and I think going into the Japanese lunch break, certainly all eyes again will be pivoting back to the Japanese currency and what this weakness in the dollar probably means as far as that trade is concerned. As we move into day two here, in the thick of day two, we're looking at markets like India, plus, of course, things like, as you can see, commodities. So global miners had a fantastic Tuesday. Global luxury stocks, ditto. So lots more in store here on the China Show.
$11:29 a.m. in Tokyo. Japanese markets heading to that lunch break in just a moment, and we're taking a look at the Nikkei. We are continuing to see some decent gains here, but really it seems like China is outpacing most of that here today. Take a look at how dollar yen is going. There has been some weakness since that Fed meeting as well. So we're at 143 levels, and people are starting to doubt how long this yen surge that we saw just a few weeks ago can last, given that you have capital outflows, you have real yields, you have positioning that seems to be weighing on the currency right now. Dave.
Yeah, just to bring to mind as well, I think there's CITIC CLSA technical analyst who joined us about a week and a half ago, called 140, but said we might be moving back to about the 147, 148 handle on dollar yen. And that's what the charts show. And that's not astrology, that's technical analysis. Both charts, of course. Both equally, or you could make the strong argument both ways. In any case, every single sector is up. Asia's up 1.3%. S&P futures are seeing a bit of a paring back. I think the biggest story on your screens would be bottom row, second to the right, the Bloomberg Asia Dollar Index, as you can see on your screens, is up 0.25%. Dollar softness continues day two. That might also mean we will get probably a lift as far as Indian equities go. Nifty futures doing this about an hour to the cash market open, and we're looking at, well, a flat here. This has been a market, of course, that's done extremely well.
Yeah, staying on India now and the outlook for private equity. There, let's get to our Markets Asia anchor, Haslinda Aman, who is in Singapore with our next guest, Has.
Well, that's right. Surging returns in India prompting the big boys in the PE sector to really pump in tens of billions of dollars. Let's get to Amit Jain, MD and head of India at Carlyle. Good to have you with us. Welcome to my city. We've been hearing time and time again about how optimistic the PE sector really is in India. It's about growth, it's about fundamentals, but we're also looking at extended valuations. How are you looking at it?
Thank you for having me here. Look, India has always had the promise for very long periods. And, often this is asked, what's the difference in the promise this time? And if you step back, to me, I think India is starting to hit its escape velocity point. And I say it with a few factors. Number one, I think you have the predictability and the continuity of political regime, which India hasn't experienced for decades, since 1947. From 2014, we have a government which is continuing, which is policy regime, which is predictable. And I think predictability keeps anxieties low, confidence high. You've got a domestic market which is being fueled by domestic liquidity. And I think that's creating a very buoyant capital market. India probably is now one of the most vibrant capital markets out in the world. And I think combination of that, yes, valuations are high. But if you're primarily a beta player, I think you worry a little bit more. At Carlyle, we primarily seek alpha by intervening into our companies, and to that extent, we're able to manage that environment a bit.
But at what stage would valuations be a concern? I mean, people talk about the risk of liquidity. There are concerns out there.
No, absolutely. And I think, if at all, I think let's keep these two separate. You've got liquidity issue and valuations. I think liquidity is at an all-time high in India. This was an issue probably 7 years back where we try to sell companies, you didn't have enough liquidity. Today, we've experienced getting $500 million to $1 billion blocks out within 5 minutes close of the market at 5% block discount, right, within 5% range. So the liquidity is pretty high. I think your point that valuations are high and at what point they become very high, I think it has to be seen in the context of high ROEs India operates in. It's a very high return on equity environment, right? Businesses are used to operating at high inflation, high interest rate, and therefore the business models throw high ROIC and high ROEs. And two, you couple it with growth. So I think as long as the growth story continues and the businesses throw the ROEs, one could justify the valuations at which the market is operating.
And they say the growth story will continue. We're looking at $6.7 billion for Carlyle over, I think, 45 deals. Where is looking attractive to you in India?
Well, we've always been, in India, we invest into what two mega themes, what we call as India for India and India for the world. India for India is primarily play on rising middle class. As India moves from $2,300 per capita to $3,000, we're seeing Indian wants to consume more. Just before me, one of the speakers was talking about the luxury sales of watches on your show, and we are starting to see that happen. Healthcare is moving towards more proactive than reactive. We're seeing financial services move from mortgages to wealth management. So I think that's a big theme. We continue to be very bullish on the domestic side. What is starting to become very attractive is India for the world on the export manufacturing side. I truly think if India has a shot at becoming the factory to the world, I think this is the place to be. You've got infrastructure building up. Geopolitically, we find ourselves in a politically, kind of favorable place. And therefore, if we could build factories around specialty chemical, packaging, auto components, I think India could really do well in that sector in the time to come.
So how have you deployed your funds differently? I mean, what have you been doing the last 12 months?
So in the last 12 months, I'll probably give a little bit more because ours is a bulky business. We're a deal-by-deal micro-investor. If you look at the last 5 years, we have invested more capital than the first 13 years. So we've been in India for last 18 years, and I think it just tells you how leaning forward a view we hold in India. And in the last 5 years, we've gone ahead, bought a bank. We own 10% in Yes Bank. We bought India's largest integrated skincare and a beauty business, a company called VLCC, which is our play on the domestic side. 4 years back, we bought the largest IT services company deal done called Hexaware, which we just filed for a prospectus for IPO. So it's been, again, mix on India for India, India for the world. Roughly 50-50 would have been our deployment on those two themes.
How do you see the pipeline for IPOs in India? You've seen about 6 companies through to IPO, and some say that India is just one of the few markets which are actually seeing IPOs.
I would say it's probably the #1 market in terms of getting, liquidity from IPO and capital market events in the world today, right? And it's evident in the fact that we've taken 6 companies public, we've filed for the 7th one, and there's more to come. I think the pipeline is strong, and it kind of links back to the point that there is domestic liquidity. India in this year has got $38 billion US of inflows from domestic savers. This is money coming in each month through a product called Systematic Investment Plan. Each month, take a guess between $2 to $3 billion, and you see this money trying to participate in capital markets in India.
When there's so much optimism, there should be caution as well. If there's one risk in India, what would that be?
I think, Indians are pretty emotional, I would say. And we require...
In what sense, Amit?
In many ways. I think we could go very happy and we can get very sad. And I think what is required fundamentally is a mindset of equanimity, where we can put our head down each day, get stuff done. So I really worry that the quality of execution should not come in the way of the scale of the promise India holds.
Credit fund. Is there any plan for a credit fund in India, or are you considering tapping, for instance, your global credit funds out there to fund your deals in India?
I think the Indian markets are maturing from asset classes standpoint. We started 18 years back. We've really built a very strong presence in the core private equity franchise we hold in India. And I think we keep evaluating what other asset classes should we enter, real estate, asset-backed financing, and credit being one of them.
It's hard to talk about India without talking about the environment in the U.S. Firstly, of course, the Fed cutting 50 and the implications, reverberations around the world. How do you see the Indian market getting impacted with the Fed that is on its way to cutting more?
2-3 things. I think one is just currency, right? India, just if you step back, India hasn't been seen the variations in inflation as some of the other parts of the world have seen post-COVID, driven by the liquidity in those parts of the world. India has had a very narrow range, 4 to 6% for decades. At least, I'm 43 years old and I've seen 4 to 6% of inflation for very long periods. India settled with that. And therefore, as interest rates come down, in a somewhat 65% domestic-driven economy, I don't see mega changes from consumption pattern standpoint. But what it does is I think the rupee should relatively strengthen because we are used to that 4.5% inflation as the as the interest rates come down in the U.S., you should see rupee strengthening vis-a-vis the dollar just by macroeconomics. The second thing is, I think as interest rates come down, global investors, we've seen money come out of India from FII standpoint in capital markets, and domestic liquidity was substituting for it. I would expect some of the foreign investors and the global investors tend to look back for growth. And Asia is more than 50% of the growth, and India is the single largest contributor in that. And therefore, more money should walk into the doors. Finally, I would say from a private equity standpoint, we don't put too much leverage in our capital structures out in Asia, because when we do buyouts, we do growth buyouts. We don't do leverage buyouts. But to the extent we have leverage on our capital structure, it should just help returns and therefore more private equity activity.
Amit, just one final question. We're on the cusp of possibly the election of the year, and people are wondering what policies might emerge from the next presidency. How closely and how concerned are you about these policies? Because players in this part of the world get themselves caught in the crosshairs between the US and China.
Well, one of the things which India has done well, and this is probably from 1947, is kept our sovereign independence. I think if you think about India finds itself so neutrally or favorably placed in the complex geopolitical dynamics we live in. We're the only country which are very close to the US, and we still have our oil trade going with Russia. So I think we do watch those elections closely, but I think India has its own story to tell and a promise to keep.
And now it is a good story. Amit Jain, MD and head of India at Carlyle. Dave, handing back to you, and you heard what Amit said. The Indians are pretty unpredictable, very emotional. So first time I've heard that, by the
way. Yes. We know a lot about that. Anyway, look, I mean, certainly when you look at that market, it's hard not to get emotional. And certainly when you look at the gold story too a lot of that also has to do with demand coming from big markets like India, for example. As you go into wedding season, certainly emotions run high, hopefully in a very good way, just to tie those two things together. While the conversation was taking place, spot gold hit a new record here of 2665. We're a little bit below that level right now. That's playing out across your equity plays, 3.5% to 4% across some of these big gold mining stocks traded across the region. Plenty more ahead. This is Bloomberg.
Travel is still more resilient. So looking at 5% consumption growth, travel is still growing at 7-8% versus goods consumption 2-3%. And secondly, some experience-related consumptions, partially also related to travel. So like outdoor spending, outdoor apparel, even it's super expensive, but selected brands are still doing really well, 20-30% growth. And in staples, beverage consumption is actually pretty good. This probably also related to when you travel, you actually consume more beverage during your travel.
Travel remains a bright spot, according to Goldman Sachs there. That was a conversation we had with Michelle Cheng, head of Asia Consumer Research at the bank, around this time yesterday, amidst this barrage of economic stimulus in the hopes, of course, to boost consumption and consumer confidence. In fact, on that very note, on travel and consumption, let's bring in our Chief North Asia correspondent, Stephen Ingles, is with us out of Shanghai. And Steve, you had the perfect guest to give us another fresh light, if you will, on this issue too.
Yeah, that's right. I mean, obviously, the consumers here in China are more value conscious. We heard that from Sir Martin Sorrell a couple of days ago here in Shanghai as he looks at the spending trends and the advertising trends, obviously. But tourism, domestic tourism through the pandemic was strong, obviously. But are we seeing a pickup in inbound tourism and also more spending as we approach the National Day holiday that is coming up next week? Another golden week in China, which is essentially a week long where people travel and they traditionally spend. Will they be doing that this year? Let's get the pulse check of the consumer as the holiday approaches with Andrew Xu. He's the Club Med China CEO as well as Fosun Tourism Group co-president. Fosun, the industrial or the conglomerate here in China, owns Club Med globally. Andrew, thanks so much. We just heard from Goldman Sachs analysts saying that there's been a bright spot in spending in certain areas of travel and leisure, outdoor activities and the like. What are you seeing right now after what I probably presume was a difficult summer with confidence so low by the consumer?
Yeah, actually, morning, Stefan. Actually, what we feel is, on one side, I agree with Goldman Sachs saying that comparatively resilient for tourism sector around the broad slowdown of the economic situation. But on the other side, definitely this industry is impacted as well. What we can see is some trend change. On one side, overall macro data showing us in the hospitality, actually this year, all these big players are facing challenges. But the people are more focusing on brand, on lifestyle, on what is the value you can deliver to them. So I should say for our own business in semester one, it's performing pretty good. We still achieve a 33% year-on-year like-for-like growth for China, Climate China business.
That's the first quarter, though.
And that's the first half. Actually.
The first half. You told me that the ski areas were strong.
Yes, exactly.
So in the wintertime, you have 3 resorts that are in the northern parts of China that tap into skiing. But you also told me summer was pretty difficult.
Yes, exactly. But actually, that's different trend. On one side, ski is quite resilient, so it's very strong. But if we go to peak seasons, we see 2 trends. On one side, people's booking tends to be more and more last minute. And on the other side, if we're talking about doubling the price, but deliver the same service as before in the peak seasons, people don't buy in. They want a price value on that.
Yeah.
So simply raise the price doesn't work anymore. So we need to think about a new product to strengthen the product value for our customers. So the total ADR side, I think, in this industry was impacted by especially in the peak season.
So you don't have as much pricing power. How is occupancy looking ahead of the holiday next week? So you have occupancy, and then you have the equivalent of average revenue per available room.
Rooms, the RevPAR.
Right, so RevPAR. So how is that dynamic looking right now for the holiday?
I should say it is also a topic I want to illustrate, which is for remote resorts. We have a clearer picture. For example, our Lijiang resort, our outbound Southeast Asia resort, I should say the occupancy and the ADR is okay. It's aligned with last year, or some outbound resort is a bit higher than last year. But for a nearby resort, a nearby city resort, definitely it's still too early to call, even we only have 1 week ahead before the holiday. So far, the booking pattern is a bit lagging behind the same period of last year, but we keep the price at the same level so far.
How encouraged are you by the raft of stimulus that we got announced yesterday? Is that going to do something fundamentally for the consumer, or is it more for sentiment? And what's it going to take to get the consumer to be less value conscious and start spending again?
It's all about confidence. It's all about confidence. So all those policies, if you want those policies, can transfer into a real consumer sector and need time. But whether these policies can strengthen the confidence of consumers, let's see. For me, I think I need to have a process or need some time to really transfer into a real consumer power rebound.
Now, a couple of years ago, actually in 2022, you said that you were planning to boost your number of properties in China to about 17, or globally. But half of those, roughly, would be in China. Was that too optimistic, given we hadn't even come out of COVID-0 by the time you talked about that, and then we have this subsequent slowdown in the economy? Are you still on track? You were talking about 17 properties worldwide by the end of this year, including half of them in China. On track? Or have you pulled back?
It's almost on track, I think. For example, actually, since the second half of 2021, we have already opened 5 resorts in China. And next year, we're going to open another one in Hangzhou called Hangzhou Longwu. It's also supported by Lucheng and the local government. Okay. I think that's going to be another extraordinary one. We're still confident in the long run for China's economy and the consuming power in China. I should say every single economy has its cycle. So that's no reason we just fall back in the middle of one cycle. We still took a more medium, long-term view and perspective toward this market.
I have to ask you about the talk and the chatter in the market about you're potentially in advanced talks with potential suitors to buy upwards of a 20 to 30% stake in the Club Med business. Capital Land Investments is the name that is coming to the fore. How far along in negotiations are we? And is this part of the process of kind of shedding some of the debt and selling some of the assets to get Fosun on a solid fiscal footing?
Yeah, actually, Fosun has identified the 4 core business. And one of these 4 is Fosun Tourism / Climate. So for these 4 core business, Fosun is aiming to still have a controlling power and bridge all those resources to strengthen the future development of the core business. So I should say, but on the other side, actually, Fosun, as always, we have a very open-minded to think about some strategic partnership for such kind of business. So far, I cannot disclose any details about these, but I should say, on one side, Climate Fosun Tourism is one of our core business. Fosun will still standing for. On the other side, we're open to talk for some minority strategic partnership.
So you're not denying that you're potentially in talks with Capital Land Investors?
I don't disclose any specific name, but I don't deny we are open-minded for minority strategic partner.
Andrew Xu, thanks so much for joining us here in Shanghai. Okay.
Thank you.
Yvonne, going to send it back to you.
Great interview there, Steve. Thank you. And our thanks to Andrew Xu there, Club Med China CEO and Fosun Tourism Group co-president. Now, if you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can join the conversation, send us instant messages to our team, to our guests throughout our live programming. Make sure to check it out at TV Go. Here's your China brief. A look at what's making headlines in the national media today. And it's really all about China's stimulus blitz in the financial press. Newspapers playing up the measures and their impact, including the surge in A shares. The Securities Times quotes several analysts who say this stock rally has room to run. And the Shanghai Securities News says that regulators' support is igniting more mergers and acquisitions. The paper reports 50 M&As among listed companies in this month alone across sectors including food, semiconductors, and pharmaceuticals. The CSRC said it will actively support deals involving strategic industries to promote, quote, new productive forces.
Meanwhile, and I like the story actually, so state media are reporting, and I think we have video of this and some pictures. There we go. The Chinese First Lady meeting with visiting American students in Beijing. That a meeting certainly highlights China's efforts to repair ties with the U.S., with Peng Yuan, quoted as saying that she hopes young Chinese and Americans will inject positive energy into bilateral relations. Now, just keep in mind the backdrop here is President Xi pledging, I believe it was last year, to bring 50,000 American students to China over the next 5 years to promote these people-to-people links amidst, of course, the back and forth at the very high end of the geopolitical structure. It's the people and people that keep really this relationship, I guess, from pivoting further away from each other.
Yeah, at least getting a bit more, I guess, in-depth sort of understanding of really...
It's nuanced,
yeah,
right? It's not black and white.
And it's interesting, right? There were efforts to do this since the summer, I think. We've covered some of these events, and, you know, some students would say, you know, it feels a little bit too scripted. But then again, it's a good direction, right, that China is going to really kind of try to mend those ties on the ground as well.
Yeah, certainly a feel-good story amidst
feel-good in markets.
Well, the feel-good story in markets. I was going to go there. Yeah, perfect segue really to go into what a change in sentiment really in a couple of days has been. So we talked about that story in geopolitics, and also maybe as a reminder that might this market run into that wall of geopolitics in a couple of weeks. In the meantime, though, the party does continue. In case you missed it, CSI 300 is now back up year to date. We'll see how long that lasts. Dollar China is now below 7 about, and UBS has come out with a note now, and they're saying hedge your Yuan exposure, go into some of the defensive and some of the losers, and the Aussie dollar is a good way to play this Chinese story.